Hello everyone, welcome to chapter 22 of CPI. In this chapter, we're going to be discussing intraday market conditions. We will learn about the different conditions and variables that shape the intraday price action during the day, right? And then we're going to see that how we can adapt to those different structural frameworks for better execution and decision making process. Now we know that before we could dive into our setup and entry models, it's crucial for us to understand and know the market conditions that we are working with. We know that intraday trading isn't just about finding our entry model on the lower time frame and taking a trade and executing it straight away. Instead, it's about recognizing the underlying conditions of the market at any given moment in time and seeing whether those conditions suits our objectives or not. There could either be high probability conditions in which you should be looking for trades, and maybe the conditions aren't right and they are low probability, and in that case you'd avoid trading at all. And in this chapter, we'll discuss all of those conditions, what they are, how are they influenced, and what's their impact on our execution throughout the day. And most importantly, we're going to discuss how you're going to classify and differentiate those different conditions from each other in the most objective and mechanical manner possible. Now, let's move on to the next slide and let's break down the concept of probabilities in trading. In this part of the chapter, we're going to understand how probabilities can seriously boost our decision making process and our overall performance as a trader. We know that trading isn't about certainty, right? It's about probabilities. Every trade you take comes with a certain likelihood of success, right? And your job as a trader is to recognize and act on those high probability setups while avoiding the low probability ones, right? You can never for sure know the outcome of a trade, never, right? Because it's not certain, but you can certainly predict the outcome of a number of trades over time by calculating their edge. Now you must have already calculated the edge either by gathering data through backtesting or going through live data, right? And that would have given you a win rate based on your data. Now the larger the sample size of the data, the more accurate your calculations about your edge would be. And let's say you have a decent sample size of data regarding your model or system which has given you an edge, and by decent sample size I mean at least 6 months worth of data in all sorts of markets and conditions. And through that data and edge, you know that you've got a definite win rate, right? You have a set win rate. That means even though you cannot predict the outcome of an individual trade with certainty, because that's almost impossible, you're still capable of measuring your performance and the outcome of a large number of trades based on your pre-existing data. Now the metric of how often you would win or how often you would lose over a large sample size of data is what we call probability, right? It's not certain, but you've got to trust your system no matter what, and the only way your progress in performance could be is close to the edge as if you consistently execute your system without any inconsistency, inefficiency, and mistakes. Otherwise, there's going to be a discrepancy in the data which would lead to an optimal performance, right? This is simple maths, nothing too complicated. Now let's talk about high probability and low probability trades. Now high probability trades are backed by your trading edge, meaning that they are aligned with the proven data that you've collected or the conditions that you've seen through your edge that statistically favor your success more. For example, trading during key times like the London kill zone 3 a.m., 9 a.m., you know that because of your data, right? You know that these times are high probability for you because of the data that you've collected from past historical price action. That's why you trust it. And without that data, you wouldn't have anything in the first place to begin with. Another example of high probability conditions are entries that align with high time frame drawn liquidity and key levels, right? These are the factors in the type of metrics that makes a situation or a particular scenario a high probability one. Now let's talk about the low probability trades or trade ideas. Low probability trades, these occur these trades occur in unfavorable conditions or setups that lack clear signal or high time frame market context. example could be that you are trading outside your key times or kill zones or key macros. That is an example of a low probability scenario, because according to your data, whenever you've traded outside a key time, it always has led to more losses than wins. And according to that data, you've classified that particular scenario, that particular condition, as a low probability one, right? It's not because ICD said it or I said it or Romeo said it. It's because your data said it, right? The reason we consider the 3 a.m. Time window during the day is a high probability time is because the data that we've collected, right, or the data that all of us have collected over years among across different instruments and pairs have shown us that during the 3 a.m. it's a good time for CRT to be purged or a key level to be tested, or for us to have a clear reaction of a key level and expansions to occur or a reversal to occur, right? And that way we can use that fact, not fact, that data, that statistical figure, and our in our side, by actually trading within that particular time and classifying it as a high probability within our system, right? This is how probabilistic scenarios are classified and derived in the first place by the data that we've collected. Now, an example of a lower probability scenario would be taking a random trade outside your strategy, which might have been driven by emotion or over trading or any other mistake. That is a lower probability trade example. And as I said before, all of this is proven by your data, because what your data shows is that if you trade during these conditions or time, then you would lose more often than you would win. And by trusting that data, you would stay out of the market at that particular time, right? And stay risk off and protect your capital instead of doing anything stupid. Now let's talk about the importance of probabilities. Now we know that understanding probabilities allows us to shift our focus from quantity to quality, right? We know that it's not about taking more trades, it's taking the right ones. First of all, avoiding low probability trades not only helps us protect our capital, but it also keeps us focused on the setups which have a higher chance of success, or the setups that have the odds in our favor. Second of all, second, that second thing is that knowing when the odds are in our favor allows us to trade with confidence and clarity, right? And on the other side, when you recognize these poor conditions, it helps you avoid unnecessary risk. The third thing is that by sticking to high probability trades, you create a more predictable and a stable equity curve over time that is going to resemble to the equity curve from the data that you've collected, right? Which means there's not going to be any discrepancy between your execution and your model's performance, which is classified or which is deemed as optimal performance. Now, the likelihood of success in any trade is influenced by several factors. Number one, market conditions, right? We know the trending market often present high probability setup compared to ranging or consolidation conditions, right? Because after all, our objective is to position ourselves in expansions, in either daily range expansions, if we are intraday trading, or in terms of swing trading, we are trying to position ourselves in weekly range expansions. That means that the market would be in our favor, or the odds of success would be in our favor if we are trading in a trending market, right? We know that periods like kill zones or after key news release events, they tend to offer better opportunities as compared to consolidation or ranging conditions. The second thing is the consistency in price action, right? Clean and predictable price movements, such as respecting key levels, following candle ranges, and the overall higher time frame trend, signal high probability trading days, right? That is consistency in price action. Now, in trading, Your edge lies in understanding and acting on probabilities. And by focusing on high probability setups and avoiding low probability trades, you're not only improving your decision making process, but it also creates a more consistent and suitable trading approach for you. Right? It makes it more simpler for you by removing the low probability scenarios and conditions by not trading them at all. Now keep in mind, sometimes the best trade is no trade at all, right? And in trading, your objective is to let probabilities guide your decision, and you'll see the difference in your performance over time by following those guidelines, protocols, and principles. Now, obviously, most of you don't have enough data to define your probabilistic scenarios for your system. That's why instead of you collecting any data, which in my opinion is recommended for you instead of blindly believing in a system, I've made these protocols for you and showed you, and I've made these protocols based on my own data that I've collected throughout the years and that have defined those probabilistic conditions for me. Right? So you're welcome. Now let's move on to the next slide and let's talk about the low probability London kill zone conditions. Let's talk about it. We know that the London kill zone provides good opportunities, but also at the same time we are aware of the fact that not every day is ideal, right? Some conditions significantly lower the probability of successful trades, and recognizing those scenarios can save you from forced trades and potential losses, right? Now let's talk about some key conditions you should avoid in my recommendation if you want to avoid low probability trades. The first one is the is after a series of 3 consecutive daily bullish candles, right? What that means is if the market has already printed 3 consecutive bullish daily candles, it's better to avoid taking long trades, long position during the London kill zone after the day that has happened. Why? Because the probability of a reversal or consolidation increases after we have an extended swing in the form of price printing 3 consecutive bullish daily candles, right? Which makes further upside less reliable, right? Now, this is not uh, a definite or an absolute fact or a statistical figure, right? It's just a protocol for me, which tells me that I need to be more vigilant and more conscious and aware of the fact that maybe I should lower my risk on this particular day in this side of particular condition, or maybe if I have enough data to back it up that it's almost better to avoid taking trades at all, then based on that data I would just follow this protocol and guideline and not take any trades at all, right? Now the second protocol is that after a series of 3 consecutive daily bearish candles you're going to avoid short position or short trades, because the after 3 consecutive daily bearish candles the market might start to retrace or consolidate, which will reduce the effectiveness of a bearish setup. Now it doesn't mean that the market will always work in that way, because as I said earlier, this is not certain or absolute. Sometimes you will see that the market leaves you behind because you stayed away because of these protocols, but that doesn't mean you missed out, because in the grand scheme of things, according to your data, it was a better decision for you, because that might reinforce bad habits into you. And you might start taking trades in those conditions, which would lead you to more losses, because according to your data that you collected, it suggested that you shouldn't be trading in these sort of conditions, right? What you need to put in your mind is that nothing is certain or black and white, right? All of this comes in the gray area, right? Even if your data suggests these conditions to be low probability, doesn't mean that every single time or that out of 100 times you will be right 100 times, right? No, fuck no. That's not how this works. What matters is that you need to be right more often than not, which means if you're right even 55 times out of 100 and the rest of the times you mismove, it would still be deemed low probability conditions because of the data, right? It's simple math. Which also means that there are going to be times where the market is going to present you an opportunity on these sort of conditions which I told you are low probability, and maybe because of that you avoided it, but still the market took that setup and it turned out to be a winner. In that case, instead of freaking out and instead of coming at me and telling me that I was wrong and I shouldn't have told you this protocol, what you need to realize and put in your mind is this is what we call probability. You can never be for sure 100% right all the time, right? There's going to be times you're going to be wrong and there's going to be times where you're going to be right, and what matters is that you should be right more often than not, and this is exactly why I've given you these protocols and they are backed by my data. Yeah. So take all of this data with a pinch of salt and test it by yourself, and don't trust it blindly because you would have doubts and you would second doubt yourself, and those sort of scenarios, right, that would always mess up with your performance and your execution, and would only lead you to inconsistency in your execution, which is something you would never want, right? Now enough of that, let's talk about the rest of the conditions that you should be avoid you should avoid trading in London. Number three is that after an extreme FOMC event, following an FOMC event that produces an extreme range, the market often consolidates as it digests that move, right? And during these conditions, price action can become choppy and unpredictable, making it a low probability environment. Number four, ahead of NFP. The day before the NFP non-farm payroll report is typically a risk of environment, right? The market tends to be cautious and range bounded, making it harder to find high probability setups. So you should avoid trading during London or even during the whole day of NFP. The next thing is if the market, the economic calendar shows multiple high and medium impact news during the London kill zone, and in that case, it's best to avoid trading. Last one is that if the Asian range is a expansion profile, right, it has already broken out and it's trending and it exceeds 40 pips, then in that case, the London kill zone is less likely to provide clean setups or opportunities, because the Asian session has already made an expansion profile, which usually indicates the market has already made a significant move, which reduces the potential for further expansion or extension of a swing move. Next one is if the Asian range does not show clear consolidation, meaning it's erratic or directionless, and in that case you would avoid trading during London kill zone. Because we know that consolidation during the Asian session provides us the foundation for London's expansion, right? And without it, the market lacks structure. And then last but not least, we have absence of a candle range or CRT, and you could guess why. Now let me say this one last time. While these are strong guidelines, they aren't fixed rules, right? You can adjust to them and play with them based on your own trading data, experience, and understanding of the market. Moving on. So now that we've gone through the low probability conditions, let's now finally talk about the high probability conditions that we should definitely trade in. These are the conditions and situations you want to prioritize in your trading plan. So, key conditions for high probability trades are: number one, recent reaction to a higher time frame key level. If the market has recently reacted to a higher time frame key level and hasn't yet reached an opposing key level, then the London session is likely to going to offer us a strong setup or a clear opportunity. This creates a clear directional bias, because we know that price is often drawn towards the next liquidity zone or key level. Number two, if the Asian range is visually consolidating and it's under 40 pips, right? A consolidated Asian range, meaning price moving within a tight predictable range during the Asian session, signals a strong foundation for the London kill zone. And when the range is less than 40 pips, it indicates that the market is building liquidity, which the London session can exploit through clean expansions or breakouts. Number three, presence of a clean candle range or CRT. A well-defined candle range provides us clear level for price to respect or breach during the lens session. And we know that this structure helps guide our setup, and then we can frame an entry around it, a logical entry around it based on the current market behavior. Number four, presence of a higher time frame key level. We know that the presence of a higher time frame key level, daily or 4 hour or weekly key level, adds significant weight to our setups. And then last but not least, the one that I always talk about is a clean higher time frame drawn liquidity. If there's a clean drawn liquidity visible on higher time frame, right, then London kill zone becomes an ideal session to trade in. Now, do you know why these conditions matter? Because high probability conditions like these align with the structural framework of the market, which increases the odds of success in our favor. They provide clear context for price movement, they create predictable setups that align with our trading edge, and they reduce uncertainty, allowing us for a more confident decision making approach and a more claritable risk management model. Now, let's move on. Here in this slide, we're going to talk about the protocols and conditions that makes a setup high probability, right? The ideal conditions and setups that give you the best chance to trade successfully during the day. We're going to talk about them. Now, the most critical factor in creating high probability setup is aligning it with the higher time frame directional buys or the higher time frame drawn liquidity, particularly the daily and the 4 hour, because it ensures that your intraday trades are backed by the broader and the higher time frame and the larger market context and picture. Now, here are the key components of high probability setups. Number one, clean order flow. Look for clean order flow where price is clearly rejecting highs and breaking lows, or rejecting lows and breaking highs. This structure confirms the market directional buys, right, and reduce ambiguity in your decision making. Number two, clean higher time frame drawn liquidity. And I don't have to talk about this anymore. You could probably guess why. Number three, SMT divergence, and it's optional. SMT divergence can add an extra layer of confidence to your setup, an extra layer of confluence to your setup, which increases the odds in your favor even more, right? Basically, you're going to look for discrepancy between correlated pairs, right, that indicate where smart money might be positioning, right? An example would be that one pair makes a higher high while the other one makes a lower low, which signals non-symmetry in price action, and non-symmetry suggests that the market makers are actively in participating, which signals manipulation and price, and then you can position yourself in the direction of the market makers and profit and capitalize on the expansion or reversal. But as I said before, it's optional, right? Number four, a strong price based narrative. And number five, a strong and clean and cohesive and logical time based narrative. And then we've got 4 hour candle range, 4 hour key level, right? Because all of these adds more weight to our trades. And then last but not least, the most important one is a key time, right? We've got all of those higher time, those above factors and metrics, but you're going to make sure that they all align with each other at a key time. Otherwise, they're going to become redundant. Now, moving on to the next slide. Let's break down when to look for buy setups, right? These guidelines and protocols will help you highlight the conditions that make bullish trades more favorable, right? Now, for sell trades or sell ideas, you just have to look for the opposite ideas, right? I'm going to be showing the protocols and guidelines for the buy trades here, and for sell setup you could do them yourself, right? So, when to look for buy setups to maximize the probability of success in your buy setups and long setups or buy trading ideas, it's essential that you align yourself with the market broader context, structural elements, and timing. So, here are the factors that we're going to look for. Number one, seasonally bullish periods of the year, right? We know that certain times of the year are naturally more bullish due to seasonal trends, right? And you're going to just check the seasonal chart for your respective pair or asset or instrument, and then look for buy setups or buy position setups in the bullish seasonal tendencies periods, right? And the periods where it has bullish seasonal tendency. I've already made a chapter on it, so you should watch that if you don't know what I'm talking about. Number two, when the current or next quarter is expected to be bullish, right? You're gonna do your quarterly shift analysis, and again I've made a chapter about it, so you should watch that and see whether we are expected to have a bullish or bearish quarter. And if the next quarter or the current quarter is going to be bullish based on past historical data and based on your analysis, then you're going to look for buy setups, right? And you're going to align that with your prevailing macro narrative. Number three, price reaction to our daily / 4-hour key level. When price reacts to these key levels with bullish confirmation, it's a strong signal to consider buying on the lower time frame. Number four, a clear, unobstructed path toward drawn liquidity. The best buy setups occur when price has a clear path toward a higher time frame drawn liquidity, right? And there are no significant obstacles or resistant opposing key level in the way, right? And in those situations, the chances of a successful move increases, and you can have a clean, explosive expansion move. Number three, ideal days for buy setups, right? We've got Monday, Tuesday, and Wednesday. They are generally the best days for bullish setups. Mondays establishes ranges or test key level. Tuesday then expands on Monday's movement, and Wednesday happens to be strong trending days with high value. And then we have Asian range smaller than 40 pips. A tight Asian range signal consolidation or liquidity building, setting the stage for a potential bullish expansion during the London or New Year session, right? So you need to remember that. And then when a 4-hour candle range is patched, after a candle range is patched, it marks the end of a consolidation period, and we then starts a expansion. And then last but not least, at key times of the day, and you know what those key times are, and if you don't know, then you should watch the time chapter that I had made. Right here you can see an intraday setup. On the left hand side we've got the 4-hour time frame, and on the right we've got the 15-minute time frame. You can see based on our high time frame daily and weekly analysis, we've determined that our drawn liquidity and our directional buys is higher, right? You can see this high right here, which is our high time frame drawn liquidity. And now our objective on the 4-hour time frame is to first of all build a time and price based narrative. And based on time based narrative in weekly profile, you can see that Monday formed a range, not a range, but it basically formed a low, a swing low, just above this rejection block, this key level. And then what happened on Tuesday is that we came down lower, took out that Monday's low, right, and tested that rejection block with this particular candle. Now this candle is the 5 a.m. candle, and that leads us to believing that it's going to be a high probability CRT as well, because not only it has taken out a swing low or in a major liquidity, and it also has tested a key level at a key time, and our drawn liquidity is higher. So now for us to frame a setup there, what we're going to do is we're going to wait for that candle range low to be purchased at a key time during the London kill zone, maybe during the 9 a.m. Time window, or the 11 a.m. time window during the close kill zone. And then we're going to frame a setup and target the candle range high and eventually the drawn liquidity higher. And you can see that's exactly what happened. Price took out the candle range low, and after that you had a model 1 entry there in the form of price closing above that down close candle, which took out the liquidity below the candle range. And after price closing above it, it turned into an order block. Price then tested that order block and then expanded higher. This is how you're going to frame a setup, and you're going to classify probabilistic scenarios and conditions based on the protocols, guidelines, and principles that I have given you. This is an example. Now for more examples, you can watch the trade breakdowns, right?